Mr. Cross, I didn't know you were an Omega.
Yes, yes, I've been in. Yeah, I went over at Lincoln University at HBCU in Jeff City, Missouri.
Okay.
Yeah. Are you Greek?
No, no. Everybody
All right.
thinks else, but no, I never pledged.
Oh, never. Yeah, okay. All right.
Like
Yeah,
me.
you never did pledge Doris?
No.
Mm. Yeah,
But I love seeing all of you when you get together.
Oh yeah.
oh yeah. Yeah.
Next week, no, wait, the first week in April, there's a bunch of AKAs are going to be in St. Louis Regional Conference.
Uh,
You said the
I'll be
AKAs?
there with bells on.
Yep.
Mm-hmm. Oh, hi, Christine.
Hi.
Christina, did you know that I was principal and superintendent of the Ethel Hedgeman Lyle Charter School?
No.
Yeah, I was when they opened it up, not initially, but when they moved to the building on 19th and Pine, they asked me to come out of retirement and and take over the school. So I ran the school for 2 years.
Oh, I was off the board by then. I got off the board in 2007
Okay.
before it went south.
Okay.
So I was on there from
Yeah, it went south,
2000,
but
2000 to 2007. I didn't like the board. Oh, okay.
Yeah, we are
okay.
live now.
Okie
Go ahead.
dokie. Go ahead, Sue. I mean, go ahead, Chris.
No, go ahead, because I'm not. I'm under the weather.
Okay. All right. I want to call the investment committee meeting for the PSRS STL. Call it to order. Call it into session, and let's start with the roll call. It's March the 20th, first day of spring, 2025.
Christina Bennett,
Yes.
Lois Cross,
Yes.
Emily Hubbard, Shanice Johnson,
Present.
Yvette Levy, Jennifer Orr,
Present.
Bobby Richardson, Albert.
Oh, Bobby is excused. Bobby's excused today. Her mom broke her hip, and her aunt has 2 days to live, so she's kind of tied up for sure right now. And if you all can just keep her in your prayers, that'd be great.
Yes.
Albert Sanders, Doris Walker.
Present.
Okay, so we do have 5, so we do have a quorum.
Okay, then I guess we can turn it over to you, Sue, and Gwelda.
Yep, Gwelda.
Wow, you froze.
So in the waiting room.
They are.
Okay, PIMCO is your all asset manager, basically your global tactical asset allocation manager. We have 2 people today, Matt Gilbert and Justin Blussy. That particular portion of the portfolio represents 3% of the fund. And at the end of February, the amount you have invested there is $24,893,903. And I don't believe they've been in here. I know they have in the last couple years. So with that, unless there's some questions from the committee, we can.
Walter, are they on watch list?
I believe they are. I need to look at the last report, but I think they are. Let me look real quick. Let me double check. February. December meeting. I think they would be per the pre-changes that we made to the investment policy document, because we recently to move it to the rolling 3 and 5 years rather than the rolling 2.
Okay.
Let me just confirm. I don't want to misstate. Yes, they are on watch.
Okay,
Okay.
thanks.
Yeah.
Okay, we ready for them?
Yes. Anybody have any questions before we go into it? Any other questions? Chris, you got this, right? Or you want me to handle it?
No, if you could see me, I cannot handle. I'm listening. Go for it.
Okay. All right, Chris. Okay, then we're ready, Sue and Guelda. We're ready to rock and roll.
Hope you feel better, Christine.
Yeah, I do too.
I know we're recording, but when we get off recording, I'll give you an update.
Okay.
Good afternoon, everyone. Can you hear me okay?
Yes.
Yes.
Good afternoon.
Perfect. Thank you very much. Well, thank you everyone for your time today, as well as your continued partnership and trust with PIMCO. My name is Matt Gilbert. I sit in our New York City office, and I work with institutions around the country very similar to the public school retirement system of the city of St. Louis. Joined with me today is Justin Blessy from our Newport Beach, California headquarters. Justin's an executive vice president and one of PIMCO's most senior portfolio strategists. Justin focuses on multi-asset solutions and is the lead product strategist for PIMCO's model portfolio business. So I know we have about 20 minutes left here. We were planning on a very quick firm update, some time on the all asset strategy, and then a few minutes at the end for questions. But before we jump in, are there any questions up front or areas you all would like to focus on today?
No.
No.
Perfect. Thank you.
I'll put your presentation up, so if you want to go to certain slides, just let me know.
That sounds great. Susan, is this you sharing or Justin, is this you sharing?
This is me, Susan, sharing.
Okay, great. Justin, does that work for you?
Up to you, Susan, and I'm happy to share as well. But if you have it up, I can guide you when the time comes.
Okay, sounds good.
Perfect. Susan, would you mind scrolling down to slide number 72?
Okay.
Thank you. So just to back up and help set the stage, PIMCO was founded in 1971, really focused on just fixed income and based in Newport Beach, California. Since then, we've really increased our scale and access. We now have 24 global offices. Oh, sorry, Susan, just one more slide, please. Thank you. 24 global offices and focus on additional asset classes like alternatives, private real estate, emerging markets and equities with just under 2 trillion in assets under management. We also have the ability to navigate complex markets with over 80 credit analysts and specialized desks in area like corporate credit, specialty finance, and real estate, to name a few. And additionally, we have a 50+ year time-tested investment process that's very data-driven, focused on risk management and analytics. Justin, happy to pass it to you, but before then, any other high-level questions on PIMCO? Great. Justin, I will pass it over to you.
Sounds good. And Susan, we run with a long deck, but we only pull a few slides at a time. So I sent a request to maybe I can share on my side to jump around a little bit as well, not to put you on the spot with a laptop in the conference room. But appreciate the time today and the investment, as Matt mentioned. So with regard to the all asset strategy, we thought it'd be helpful just to provide a refresher on the approach to the strategy, and then dig into both performance as well as outlook. So in terms of the background on the strategy, and hopefully my screen now sharing, Matt or Susan, if you could confirm. Just as a reminder, the all asset strategy is a very differentiated multi-asset approach. So the strategy has been around for nearly 25 years. And ever since its launch, it's really had 3 key objectives. One is to achieve attractive long-term real returns. 2 is to achieve attractive long-term total returns. And 3 is to achieve attractive long-term but to do so with diversification to equities and to have more of a reflationary and inflationary bias. The way that the strategy goes about achieving that objective, and why I note that it's differentiated than most traditional portfolios, is that most traditional multi-asset portfolios look something like the pies on the left. They have a healthy allocation to mainstream equities, US equities, maybe some international equities, and then high quality bonds. And then maybe sprinkle on the outside some of what we call diversifier assets, which throughout this presentation you'll see in green. To achieve the objectives that we have that I mentioned earlier, attractive returns, but with diversification equities and a reflationary bias, we tend to invert that in terms of the allocations that you see. We tend to put at the center of our allocation some of those diversifier asset classes like TIPS, Treasury and inflation protected securities, REITs, commodities, credit strategies, EM debt and equity, and liquid alternatives. On their own, each of those can achieve attractive returns when they're when they have good valuations, and many of them offer diversifying properties as well. We will allocate to U.S. equities and international equities as well, but typically only when they're attractive and cheap, because we want to diversify away from U.S. equities. We want to be that complement to a more traditional equity bond portfolio, and also we'll allocate to bonds when either they're cheap or we want some dry powder or to get a little bit more defensive. And I'll come back to that, but that is somewhat the environment we find ourselves in today. Now, the strategy in terms of achieving those objectives over its long history has done that. So if you think about those diversifier assets that I just mentioned, if you had a kind of an equal weight to those going back historically, that's the light green bar here. The other asset classes sometimes clients will focus on are just the inflation sensitive ones, the TIPS, the REITs, the commodities. That's the bar to the far left. And then all asset is in blue. So since our inception, we've had higher returns, a higher Sharpe ratio. So we've gotten those returns with lower volatility. On the risk side, we've had lower volatility, lower drawdowns, lower equity beta, less co-movement with equities, and a higher correlation to changes in inflation and expectations. The thing to know about our style, though, just hitting one more slide, is that because we tend to center on those asset classes outside of U.S. equities, outside of mainstream equities, it's important to keep in mind what our home-based markets are doing to evaluate our performance. So what you can see here is since the inception of All Asset back in 2002, you can see what kind of high-quality core bonds did in the blue line. You can see what U.S. equities did in the red line. And you can see what our home-based markets, the diversifier mix I mentioned earlier, did in the green line. Now, the first decade of All Asset was a period where U.S. equities faced a lot of turbulence. In fact, in the 2000s, U.S. equities were slightly down when you include the tech bubble in the early 2000s and the great financial crisis in 2008. During that environment, diversifiers did much better. They were cheaper to begin the decade. They ended with much higher returns. But the next decade, we saw kind of this pattern reverse. We saw U.S. equities, you can see here in red, kind of this exceptional performance, one of the few asset classes to have these double-digit returns over a whole decade. And you can see diversifiers and bonds a little bit more muted returns. The reality, though, is these longer performance cycles do tend to revert, right? And when you look back decade by decade, again, the reds are U.S. equities, the blue are bonds, the greens are diversifiers, we see this pattern persist. We see the most recent period on the far right, where U.S. equities have led and done well. But the period preceding that, we see what I mentioned earlier. U.S. equities doing poorly amid the tech fallout in the GFC. Diversifiers doing much better. You go back to the 90s, same story. U.S. equities doing better, diversifiers not quite keeping up. But before that, especially in the 70s, you could see diversifiers doing better. So this pattern of one outperforming the other is nothing new. And when we think about the strategy itself, it's often used as a complement to more traditional core holdings in a portfolio, U.S. equities, high quality bonds. It can be that return driver when equities are not doing well, like the 2000s, or it can diversify, when equities are selling off, much like year to date. Year to date, U.S. equities are down, peak to trough, they're down about 10%. Year to date, they're down a few percent. All assets up nearly 4% year to date. So again, it's that complementary approach. So let me pause there. I'm going to dive deeper on near-term performance. I'm going to dive deeper on outlook, but did want to pause there for questions or any comments. All right, well, happy to keep unpacking the near-term performance. So if we look at 2024, We were nothing if not consistent. You again seen kind of US and international equities in red, high quality bonds in blue, and diversifiers in green. What you see in 2024 was largely a continuation of what we saw on the prior chart. Continued exceptionalism of US equities. The S&P was up 25%, with most other asset classes, having positive returns, but much lower overall. So an equal mix of diversifier asset classes in 2024 were up about 4.5%. Bonds were actually slightly down because we saw rates rise modestly again, on average down about 1%. So when you think about evaluating the portfolio of all asset in any given shorter period, a quarter or a given year, often many of our clients look to that diversifier mix to say, are you in the right ballpark in terms of what we should expect out of this portfolio that centers on these out of mainstream asset classes? And the answer last year as well, as it has been historically, was yes. Last year, the strategy was up a little over 4%. So just a shade off of that diversifier mix of 4.5%. But we do have an emphasis on bonds, which we'll come back to, which were down 1%. So having, call it about 60% of the portfolio in diversifiers, close to 30+% in bonds, being, diversifiers up 4.5%, bonds slightly down, being up about 4%, we think was pretty good last year overall. And in fact, some of that was just given back in Q4 when rates rose and some asset classes sold off. We were on track for quite strong performance for the year. Year to date, this is through February, up about 3.5%, through yesterday, closer to 4%. And this is really a good kind of indication of why you have an all asset strategy, why you have a complementary strategy versus, the equities in your portfolio, which I'm sure have been doing quite well recently, which is when equities sell off, like they have year to date, we're there to help supplement returns, to either draw down less or have positive returns. And if we look forward and we come back to our outlook in a minute, we do think we're entering another period in the next decade where US equities are very rich, the price to equity ratios are very high, therefore the expected returns on US equities are much lower, whereas many of our asset classes, in part because they haven't had as strong recent performance, we think are poised to have much better performance on a go-forward basis, both diversifier asset classes, but even bonds themselves, which offer very attractive yields today. And so to round things out with prepared remarks, and then we can open up to additional questions, I wanted to touch on our current portfolio positioning. So what this bar chart shows is the full history of our allocations going back to inception. The coloring is, again, nothing if not consistent. The reds at the bottom are US and international equities. The greens are different diversifier asset classes, so EM, debt and equity, commodities, REITs, TIPS, credit strategies. And then the blues are high quality bonds, short-term bonds, core bonds, long duration treasuries as well. What you'll notice, the last 4 bars here are the most recent quarters, and then every bar prior to that is a recent snapshot of a prior year end. What you'll notice more recently is a lot more of the blues, right? So after yields increased significantly in 2022 for high quality bonds, their forward-looking returns became much more attractive. Returns in bonds are very highly correlated to starting yield. So when we see a 5% yield on a high quality bond with very limited credit risk, something that if yields come down can even have a higher return than that, that's a very attractive place for a diversifying strategy like ours. And so we have significantly increased our allocation to bonds in the more recent period. From a diversifier perspective, we have a pretty even mix across several different return-seeking asset classes, ones we think are much more attractively priced than US equities today. So that includes emerging market equities, REITs, commodities, emerging market bonds. Many of these strategies have return forecasts in the high single digits, if not double digits, with kind of volatility levels in a similar range. So from a risk-adjusted perspective, they look very attractive. And we have very limited US equities. I mentioned earlier, valuations, price to equity multiples are very high. Therefore, forward-looking return expectations on US equities are much lower, unlike the last decade where the realized returns have been quite good. And for a strategy that explicitly looks to diversify away from US equities, we have a high bar anyway to having US equities in the portfolio. In fact, the highest we've ever been is about 19% when equities were coming kind of off of the dot-com bubble and were looked fairly cheap. When you put that all together, the last thing I'll mention is in the upper left, we show the overall yield of the portfolio. So this is the yield to maturity on bonds plus the dividend yield on equities, and that's a little over 7% today. Said differently, if prices didn't move on asset classes and you were just clipping the dividends or clipping the coupons of the fixed income, your forward-looking returns basically anchor on that 7%. Now, we know prices will move around that, but if anything, if we get a more benign environment, a softer landing than expected, then we would actually expect potentially returns above that, higher single digits as we get price appreciation. If we get more of a risk-off environment, which we're already started to so far, at least in U.S. equities, we have a lot of the bond positions there to diversify the portfolio. Given that we have high starting yields, there's a lot of room for bond yields to fall, to get price appreciation should we see equity markets sell off. That'll help buffer the downside. We should do much better than a traditional 60-40 portfolio in that kind of environment, and offer the opportunity, if we see asset classes being cheap after a recent sell-off, to reallocate some of those defensive bond positions into newly cheap equity or diversify our asset classes. And the last thing I'll mention, I know 60-40 is used as a benchmark internally. We do see clients sometimes using that from an overall volatility perspective. All assets had a volatility historically of about 10%, a little under about 9%. That's not too far off from the volatility of a 60-40 portfolio. But hopefully from, in terms of, performance direction, a 60-40 portfolio is going to be heavily influenced by U.S. equity performance. And obviously our portfolio tends to have a very limited U.S. equity performance. So that's something just to keep in mind. We can always send and reshare the diversifier or full asset class mix performance as a reference point. We tend to look at that a little bit more as a little bit more clearer guide of how we're doing, because it tends to focus on those asset classes that we hold as structural allocation.
Justin.
Yes.
Well, that quick question. I see you've got the historical positioning summary here. Do you have bands, minimum, maximum, and the different diversifiers? And what's the highest allocation you typically would go to in your bond portfolio?
So the prospectus guardrails are twofold, and they're fairly wide by design. So max we can have in dedicated real assets, TIPS, REITs, and commodities is 75%. And the max that we can have in U.S. equities is, total equities is 50%. Now, those are pretty wide bands. The reality is the way that the process models in terms of the allocations is that we're going to be much more diversified across these asset classes, as you can see here, than going all the way to 75% in real assets or 50% in equities. The way that we allocate is that we look to maximize forward-looking returns, but subject to a volatility band of 6 to 10%, right? And that's, at the high end, what 60-40 would give, at the low end, kind of what higher risk fixed income would give you. So it kind of is in that band. And what it forces you to do is we can't load the boat on, higher risk assets, because it's going to put us well outside of that higher end of the risk range. And we can't just get completely defensive where we're almost in cash because of that lower guardrail. So as it relates to what you've seen historically, if there's a high conviction position or asset class, the max it'll usually get is maybe 20% in the portfolio to give you kind of a loose guardrail, sometimes a little higher than that. And from a bond positioning, I would say overall the blues, this 40-ish% range is the highest that we've historically been, and probably about the highest that we ever will be. And, the reason again for that today is that we think bonds have very attractive returns on their own. And we really like their defensive properties. Given that higher yields are much higher, unlike a 2022, they're good. We think going to give us very good diversification if we see more of a harder market landing or a harder market sell-off.
Okay, thank you.
So I know we're right at time. The only thing I'll just mention or leave you with is that, it's been really heartening, I think, in the last 2 months to see some of how quickly some of the tide can turn, right? We had U.S. equity market exceptionalism in terms of performance for over a decade. But we're starting to see some of the challenges of, relying on that one asset class to drive returns, and hopefully the benefit of having a complementary strategy like all asset in the portfolio to give you returns when U.S. equities might not be. and certainly to give diversification versus what has been a very historically good part of the portfolio and what should continue to be U.S. equities, a large portion of the return-seeking portion of many clients' portfolios, but not the only portion, right? There's room to have that diversifying strategy like all asset to complement things overall.
Any other questions from the group?
I'm good. Susan? Mr. Cross?
Oh, okay. No, I don't have any questions. Let's see, is that the end of your presentation?
Yes, it's I can stay over for sure, but just was trying to keep it on schedule if you had others joining after us.
I understand. I'll put this question out again. Do we have any trustees or Sue, anyone that has any questions about what he's presented so far? Okay, then you can go on and finish up.
Okay, well,
Gwelda?
just want to, go ahead. Because we're good on our side, so thank you.
No, all is good here. They answered my question
Okay.
regarding the band. And you'll see their performance in our flash report. Things are starting to improve.
Okay.
Thank you both.
Well, thank you very much for your time.
Well, thank you very
Yes.
much for the time and opportunity to meet today. And everyone enjoy the rest of your day. Thank you very much.
Thank you both for joining.
Absolutely. Thank you.
Okay, thank you all. Okay, bye-bye. Okay, Sue,
Any questions of
got any questions? Anybody have any questions? Sue's, Christina's under the weather, so Al's not available, so I'm gonna kind of work with you, Gwelda. Where are we now?
I think the next thing is the rebalancing, correct, Sue?
Yes,
That's
rebalance.
like, you get a document up. Okay. Gwelda, are you there?
Did we lose her?
Think we might have.
Did we lose her, Sue?
Here I am, I'm back.
There she is.
Oh, okay.
Keep going
Okay.
out. I don't know
All right.
what's going on. I keep losing you guys. Okay, can you all see that?
I'll make it a little
Yes,
bigger.
I can.
It'll just be multiple
Make it a
pages.
little larger.
Okay.
Yeah.
Okay, so we work with Sue every year regarding making sure there's enough money out there for benefit payments, expenses, et cetera, cap calls. And the amount that she's requested us to raise was $60 million. And as you can see here, it's broken out by different asset classes where you see the flow in the middle of the page. And then you see what the target is. The target for the portfolio is in that last column, which is policy. And then the column next to the last column is after the rebalancing, proposed rebalancing or liquidations, you see what the percentage is. So we are well within the target ranges in that in the portfolio, even after we raise dollars to benefit payments and expenses. As you can see here, from equity, the total equity, we're talking about raising 42 million of that, with the large chunk of that coming out of domestic equity, as we have seen a run up in that particular portion of the fund. Then you see 20 million of that 42 out of domestic equity, 15 million out of international, from all three managers, Fidelity, Causeway, and DFA. Invesco we're not touching. Global equity, $7 million of that international of that equity portion. That would be the Exponent's portfolio. Then if you go down to the next section, it's fixed income. Let me explain this a bit. We're talking about only $4 million coming out of approximately 4,001,748 coming out here. The other movements you see there, you see Manulife, it's 25 million coming out of there. That is going to Loop. Remember, you all hired Loop and you hired Wellington at the meeting earlier this year. So that 25 million for Manulife goes to Loop. And then for the Wellington portfolio, you're seeing basically 24 million come out of the Lazard to fund the Wellington portfolio. Basically, that is being liquidated, the Lazard emerging markets. And then the balance of that is the 4,001,748 coming from Loomis Strategic Alpha. So that makes up the fixed income portion that we're liquidating to raise funds. And then in alternatives, the only area you can really pull from are the PIMCO All Asset, who presented today, and only $2 million coming out of that. And two of your hedge fund managers, Grosvenor and Whitebox, $6 million each coming from that. And at the bottom, you see the total amount for the system being raised of $60,001,748. So that's basically the rundown on our recommended rebalancing and raising of funds for benefit payments, expenses, cap calls. Are there any questions?
I just wanted to mention, Gwilda, that of course we will do this in stages. We will not pull the full 60 million. You know, we'll just, as we go each month, we'll see what our pension payroll is. That's typically around 8.5 million or so a month. Capital calls, depending on how that looks, will determine how much we pull out each month. So it will be a gradual pulling from the managers.
Any questions?
Okay, we can proceed. It seems like we don't have any questions, Gwilda.
Sue, do they need a vote or no?
Yeah, there is a motion, so let me get that up.
Okay. Trustee Orr, are you still on the line?
Yes, wait a minute.
Oh.
Okay, I was just wondering, are you still there? Okay, is this the motion?
It is.
Okay, Trustee Orr, did you want to read that motion for us? Is she still on?
Yep.
Yes, I'm here. Rebalancing.
Okay.
Number one,
Yes.
rebalancing. To recommend the rebalancing plan per the proposed target assets, allocations as presented by investor consultant Marinier.
Second.
Okay, it's been moved and seconded. Let's have a roll call vote. Sue?
Christina Bennett.
Is she on?
She's on mute.
Okay, Sue, Christina, you're on mute. Probably under the weather so bad. Can you raise your hand or something?
Yeah, she's not on camera either. So we'll come
Okay.
back. Maybe she'll.
We'll come back to her. Yeah.
All right, Lewis Cross,
Yes.
Shanice Johnson,
Yes.
Jennifer Orr,
Yes.
Doris Walker,
Yes.
and then Christina, are you there?
Do we have enough to pass it, Sue?
Well, this is a recommendation, so we do have a majority, so we.
Majority. Okay.
Yeah, we can move this forward. It'll come to the April 21st board meeting for a review by the full board.
Okay, that's fine then. I don't know if I know Christina said she was under the weather, so or either we can get back with her later and get her vote, I guess.
Yeah, but we're fine. We have majority have voted for it, so.
Okay, well, that's
It's
fine then.
just to present it to the full board, so we're good.
Okay. All right. What's next?
It's your performance review.
Okay.
Right, I'll get that up for you.
I'm hoping my internet holds. I don't know what's been going on. It's been dropping.
Yeah, and if you
Yeah.
if you need to go off camera, Gwelda too, that's fine. That sometimes helps.
Okay. All righty. So February 28th, just a few comments. We move to the next page, Sue, regarding what's happening in the markets. As you all know, it's been a lot of volatility in the markets. And before I get to this page, I'll basically say, as you know, the Fed met, the Fed came out yesterday, no change in rates, and they're left steady. No rate cuts yesterday, possibly 2 this year, maybe in the first one coming in June. Inflation is still not, it's still up. And we don't, actually, the Fed doesn't expect inflation to hit the inflation target. The goal is 2%. It's expecting it to go to 2.7, 2.5. So we may not get to that 2%. And there's an expectation of slower growth and an increase in unemployment. I know you've seen the news with all the layoffs in the different government departments. So the problem with that is the combination of higher inflation and the increase in unemployment is what we call stagflation. We're hoping that won't happen. But if this continues in this vein, we may run into that problem. So we'll see. The Fed is in a really precarious position at this juncture. Inflation is up. If he lowers rates, that's going to have more people with more money into the economy, which will push inflation up even more. So it's in a really awkward position at this point. It's a balancing act. So for now, everything is being held steady. The market's been a bit squirrely with the tariffs on, tariffs off. I know you've all seen that. So we just got to hold on and see where things go. But you probably have all experienced increases in prices at the grocery store, et cetera, and goods and services going up because of the tariffs that are imposed, which are passed on to the consumer. These companies are not going to eat all of those increases. They will pass it on to the consumer in the price of goods. And actually, we'll probably see the effect of that as these go into effect, because some have not gone into effect yet. For the month of February, as you can see here, we had a some weakness in the markets. As you can see there in that first column, it says month. The Russell 2000, representing the small cap stocks, was down the largest percentage at negative 5.4. On the Russell 1000 growth, large cap growth stocks, which includes things like Tesla, Amazon, et cetera, down 3.6. The positive is the Russell 1000 value. As you all know, growth has been the place to be for several quarters now. As you can see here for the month of February, the Russell 1000 value, representing large cap value stocks, is positive at 0.41%. That Russell 3000 is a combination of large cap and small cap and mid cap stocks. As you see, it was off 1.9, with a large chunk of that, of course, being in the Russell 2000 stocks and the growth portion of that index. Positives here, the developed international markets, MSCI EAFE represents that at 1.94, and emerging markets 0.48, both positives. And you can see here, year to date, the only areas of the market that are off is the Russell 2000, which is small cap, and the Russell 1000 growth. All other segments of the domestic and international markets, as you see, are positive, with the EAFE developed markets internationally having the strongest return year to date through the end of February at 7.3%. If you go over to the right there, in that year to date, You remember, this looked differently. As you can see there, the value portion is the green or light green portion having the strongest returns on a year to date. So we'll see how this progresses over the course of the year. If you go down right below the equities, you see fixed income. As you can see here, we had a good month in fixed income. The U.S. aggregate representing the largest or broadest portion of the fixed income market, domestic market at 2%, investment grade bonds at 2%, corporate high yield positive 0.67, and global bonds at 1.43. Year to date, we see strong numbers there. As you can see, all of those are at 2 or in excess of 2% in the fixed income portion of the capital markets. Any questions on the landscape before we move on to your fund? Okay, so you can go to the next page. As you can see here, these are the gray bands represent the minimum and maximum in the targets for your fund. And so everything is pretty much in line. And you can see places where we have pulled money. The bulk of the money are the areas that actually had a little bit gain over the target. Large cap equities, international, developed international equities, global equities, hedge funds. So you'll see those are the areas where we pull the largest portion of the money from, but you're still well within your target range. And as you can see here, the market value of the fund at the end of February was $873,154,495. You can move to the next page. So, as I told you earlier, Mr. Cross, no, we will not be hearing Jaws today.
Okay, Gwilda.
Okay.
That's always a good thing.
And here, the fund had a slight positive return, 0.19% for the month of February, fiscal year to date, over the policy index at 2.2%. So you're in what has been but of a squirrely market, your managers have delivered returns in excess of the policy index. If you go down the page, we'll dig a little bit deeper. We won't talk about the index funds, but where we had seen some challenges was in large cap.
Christina,
Can you hear me?
are you getting ready to
Yes,
go
I can hear you.
somewhere?
I'm here.
You said
So
where?
The large cap value manager, Edgar Lomax, has rebounded in the month of February, which has brought their year-to-date returns up, their fiscal year-to-date returns up, and some of the longer-term returns. As you can see, Edgar Lomax in the month of February delivered a return significantly above the Russell 1000 at 3.52%, which brought their fiscal year-to-date return up to over 300 basis points over the Russell 1000 value, which has helped their one-year return, has brought up their 3-year return. 5-year return is still off a bit, but remember, large cap growth is where the bulk of the returns have come in the large cap portion of domestic markets. But as you can see here, the 10-year and since inception numbers, they're now above their index. And they were one of the managers that was on watch. And what we did was, if you remember, we did the same thing there that we've done in large cap growth. We balanced it out with an index fund. So a portion of the assets of Edgar Lomax are now in the large cap value index fund, which you can see here just basically mimics what is the index, the Russell 1000 value. You move down a little bit on that page, Sue, you see TCW representing your large cap growth managers, large cap growth segment of the market. And as you can see here, the manager actually protected a bit by 6 basis points in a month where large cap growth did not do as well, a negative 3.53 versus negative 3.59. Year to date has protected by over 100 basis points there at a negative 0.14 versus a negative 1.69. Slightly off for the 1-year number, but we all know what's causing that in the longer term with the concentration of that Russell 1000 growth index, but holding up well in more recent time periods. So you can move to the next page. Okay, where we saw weakness, as you remember, was in the small cap portion, but even in this portion of the market, portion of the capital markets, you can see here that the combination of your small cap, micro cap managers actually protected a bit by a little bit over 10 basis points, a negative 5.22 versus a negative 5.35. Fiscal year to date and 1 year number, not quite as strong. In that portion of the fund, you can see here the manager that protected the best in this environment was Westfield, which is a Russell 2000 growth manager, losing a negative 5.65 versus the index at a negative 6.77. And that has kept them above their benchmark on a fiscal year-to-date basis or year-to-date basis. A little bit more struggles with the systematic, your small cap value manager underperformed this month, and the DFA microcap portfolio underperformed this month. But more importantly for these managers, if you look at each of these managers since inception and on a longer term basis, when you're looking at 5-year, 10-year numbers, and even the 3-year numbers, all of these managers have exceeded their respective benchmarks in all the rolling time periods measured here. So that segment overall, small micro cap long term since inception has delivered a return of 10.41 versus the Russell 2000 index of 7.97. So that's why you're diversified in different portions of the market. There's some times when these different areas will not perform as well, and the combination of them all balances it all out and smooths out the return. Then we go to international. As I mentioned, developed international was one of the best performing areas of the market in the month of February, and it is evidenced here by both your Fidelity and Causeway. Your growth and your value managers both exceeded their respective benchmarks and delivered a return for the total segment of 3.27 versus 1.94 for the EFA index. As you can see here, Fidelity returned 1.58 versus their custom benchmark of 0.13. The fiscal year-to-date return is good. The 1 year, 3 year, 5 year, 10 year, and since inception are all strong. Causeway represents international value. And as you can see here, a return of 4.88 versus 3.73. And their year-to-date or fiscal year-to-date is very strong at 10.31 versus 9.02. And the same pattern here as with Fidelity, these developed managers have exceeded their benchmarks in all rolling time periods measured in this performance. Now we move down to emerging markets equity, which also was a good area for the month. And as you can see here, DFA delivered well here with 0.97 versus 0.48. The fiscal year-to-date number and 1 year number aren't quite as strong, but longer term, when you look at the 3, 5, 10, and since inception numbers, they've exceeded their benchmark. Invesco is the manager that we have had some concerns about, and I believe they're one of the managers on probation. As you can see here, they have a negative 0.34 versus 0.48. And on a fiscal year-to-date basis, and the 1 year numbers, they're a little more challenged. The only time that they are looking pretty well, almost in line is the 10-year, but since inception, they are below their benchmark at 2.71 versus 3.37. We had them in a few meetings ago, and we're still watching them for possible changes. The way they said we're looking for improvement there, but we have discussed possible changes in that particular with that particular manager.
Okay.
If there are no, go ahead. If there are no questions, we'll move to the next section, which is global equity. Global Equity Exponence is your manager of managers. And as you can see here, they delivered a positive return versus their benchmark, which was negative 0.18 versus a negative 0.6 for the month of February, which has brought their fiscal year-to-date return up over and above their benchmark. 1 year return, not quite as strong, a little bit more challenged on a long-term basis, but since they were hired in 2020, they've delivered a return of 10.3, slightly below the world index at 10.76. Excuse me. Okay, so if there are no questions on domestic or international equity, we move to fixed income. Fixed income actually was strong too. That's why you all are seeing a slightly positive return for the month. Collectively, all your managers have done a good job in the month of February. So you can see here return of 1.77 versus 1.40 for that segment for February. Long-term returns are also strong versus the benchmark. The 1 year return at highlight here, you see almost a 7%, 6.99 versus the custom benchmark at 3.25. So if you drill down, we break this out between the core fixed income, which is represented by Manulife and Earnest Partners. Both of your core managers delivered returns in excess of the Bloomberg aggregate. Manulife at 2.34 and Earnest Partners at 2.50 versus the benchmark at 2.2. And if you look across the board with both of these managers, they both have exceeded in most time periods the benchmark, with the exception of Earnest Partners was off by all time periods, both of them have delivered in excess of their benchmarks since they were both being hired. Manulife going back to 1987 and Earnest Partners going back to 2008. In opportunistic fixed income, you've got you've got TIPS, which is the index manager, matching the Bloomberg TIPS index. The Loomis sales Strategic Alpha off a bit for the month of February. Their numbers don't pull up until the 1 year number there, 1 year, 3 year, 5 year, and since inception numbers exceed with some weakness in the most recent time period. Neuberger Berman, your global opportunistic manager, basically in line with their custom benchmark for the month of February. Physical off just a little bit, but the 1 year number is strong, a little bit more mixed bags with them on a longer term basis. And the Lazard EMD is the manager that we're looking at. We're replacing, as you can see here, has underperformed for the month. Fiscal year to date, the 1 year number has been very challenged, and the long-term returns of this particular manager have been below their custom benchmark rationale for us moving out of that particular manager. The next page, Sue. You see here, PIMCO All Asset. As I mentioned, they had been, they are on watch. And as you can see here, the month they did really well, and fiscal year to date, they did really well. 1.71 for the month of February, fiscal year to date, 3.57 versus 2.50. So their asset allocation strategy has worked for them in the most recent time periods. The past year was a little bit more challenged, as you can see there. Below, and that pulled down their 3 year and the 1 year number rationale because the old policy had a 2 year rolling time period. So that made sense why they were on watch per your policy. Now, if you look at the 5 year, 10 years since inception, PIMCO All Asset Fund with their diversifiers have added value since they were hired back in 2011. And then lastly, interest, of course, is basically being liquidated out. But as you can see here, you've got Whitebox and Grosvenor. Whitebox being the manager that did the best in the month of February, 0.68 versus a negative 0.06 for the hedge fund multi-strat benchmark. Fiscal year to date off there, but the 1 year, 3 year, 5 year, 10 year, and since inception, Whitebox has delivered over and above its benchmark. And Grosvenor, with some weakness this month, a negative 1.13 versus a negative 0.15. which hurt their fiscal year to date number, but the 1 year, 3 year, 5 year, and since inception, they've also exceeded the benchmark. So totally the hedge fund managers as a roll up, if you look in that total hedge fund line in gray, with the exception of the fiscal year to date and the month, that segment of your portfolio has exceeded the composite index for hedge funds. And the only other thing is the next page is real estate, which they don't report on a monthly basis. We only have them on a monthly basis.
Hey, Gwilda, I want to say thank you. I have to jump off,
Sure.
Lewis, but I just want to
Yes.
say thank you.
You're quite welcome.
Okay, I hope you feel better, Chris.
Thank you.
Hope you feel better. Okay.
And those are all of my prepared remarks. Unless, Sue, there's some questions on the other memo, which I guess it would go into executive session. Are there any questions? Are there any questions of me regarding the performance or where we are with some of the transitions? Okay.
Any questions? Okay. Well, if any questions? Okay. All right. So this is where we are now. We're going to go in executive session.
Well,
Sue?
that would only be, there was a memo that was included with the meeting notice and included with here. That just really kind of talks about one investment. So there's really, I don't know that Guelda has a lot to add to what was in that memo, so.
I don't.
I guess, if there are any additional
Okay.
questions, perhaps we could do that at, the next board meeting or the next investment committee meeting, but, just really wanted to call everybody's attention to that memo. There's nothing in there, it just pertains to one of our investments, but nothing's changing with that investment or anything like that. It's just some new information that we wanted to share, with the trustees.
Okay, so then we'll just park that until the next investment committee meeting, which will be next month, right?
Yes, that's right.
Okay, so anybody have any objections to that? Okay, that being said, then we'll just put that on hold until the next meeting.
Okay. Well, those are all my prepared.
Okay,
Giving you all half an hour back.
yeah, I tell you, Guelda, what can I say?
Tell Jeff what you did.
Okay,
I'll tell her.
so thank you so much, Guelda. Thank you so much.
Oh, thank you.
All right, Sue, we have anything else?
There is nothing else on the agenda.
Okay, can I get a motion to adjourn our meeting, investment committee meeting?
So moved.
Is there
Second,
a second? All in favor?
second. Aye.
Okay, then, any opposed? Any abstentions? See you all real soon and happy first day of spring, even though it was 35 degrees this morning.
Oh, y'all take care. Bye.
Goodbye.
All right, you all take care. Bye-bye.
Good evening.
And thank you all for your time.
All right.
Bye-bye.
Bye-bye.